The last year has been a terrible one for us, with our main bets suffering disproportionate punishment in the markets since the all-time highs of 2021. This situation is testing the conviction of our stakeholders. The question now is, what will happen in 2023 in the markets and the economy? The bad news is that the Federal Reserve has become extremely aggressive and hawkish. The good news is that we are beginning to get data that is confirming that the US economy is in recession. And if you've tuned in before, you know that we believe that Europe and China effectively have been in recession as well. So now we are in a global recession. We're also getting a lot of indicators that prices are coming down. And I think this notion that the inflation that everyone has been worried about is quite a wrong way of looking at the world right now. We believe that deflation is the much bigger risk. We've been saying this for a time. We've been ridiculed for saying it, and we were challenged by those who were sure that we were back into a 70s-style inflation scenario. We think that the pricing action, and I'm not just talking about stocks and bonds, I'm talking about commodity prices, crypto prices, and perhaps soon even housing prices, that many people will conclude the greater risk is deflation. And as you know, we don't think deflation is a bad thing. It is a bad thing the way the Fed has approached it. But deflation can be a very good thing if it is caused by technology and progress. And we think we're going to see a lot of that over the years, but right now we're looking at bad deflation, and we're going to have to get through this. So bad news and good news, darkest before the dawn. We think growth is going to be scarce this year, and as you know, innovation is all about growth. Innovation is also about solving problems. We have a lot of problems now, and a recession is going to be providing another set of problems. Crypto had its worst quarter since 2011, and it's a much more mature market than it was a few years ago. So that's saying something. The index S&P 500 was down 24% some months ago, and Nasdaq down roughly 35% from highs in November 2021. So the stock market has not seen a worse year to date since 1962. And that was when the Cuban Missile Crisis took place. And then what happened after that is we ended up in the Great Society and inflation took off. When it comes to bonds, this has been the worst year-to-date performance in bonds in anyone's lifetime. And by some measures, the worst since 1788. That's more than 250 years ago. So it's been a very, very rough market for investors. We think there is light at the end of the tunnel. The light is that the Fed is getting a lot of signals that will ultimately end up in the lagging indicators called the PC and the CPI. And I think a lot of companies are going to be telegraphing in their earnings reports this next month that we are in recession. I think the reason for the pivot of Fed, the moment when they will start lowering interest rates, is going to be a massive amount of deflation in the system. It's already here. If you look at commodity prices, the gold price, for example, it actually peaked in August of 2020, and it's at the lower end of a 2-year range. On the other hand, the price of copper has broken down from its historical highs. Oil is breaking down. Lumber has crashed. Iron ore as well. Freight rates out there are suggesting that the supply chains are loosening up quite significantly. The rates are coming down. So we've got deflation in the system. The way I describe what's going on right now, I was in my early days in my career in the early 80s, when Paul Volcker, the president of Federal Reserve at that time, was taking a sledgehammer to inflation because it was embedded in the system. After 15 years of profligate spending, in Vietnam War, Great Society, and then going off the gold exchange standard, a sledgehammer to down inflation, that's what he needed. That is what I believe Chairman Powell also thinks he needs. And we just don't think that's true because we see so much deflation. And one more thing, we also see a massive inventory overhang around the world. You've got European recession, China in recession effectively, and here in the United States, retailers are bulging with inventories which will have to be cleared with discounts. We're going to see some major downside surprises in inflation during the next 3 to 6 months. The Fed is looking at the PC, the Personal Consumption Expenditures Price Index, which peaked 1 year ago at 5.3%. Now it's down to 4.4% in last month, and we believe we've already seen some negative numbers. Nobody believes them. We do, and we believe we're going to see some more negative numbers during the next 3 to 6 months. So, I wouldn't be surprised to see it well down into the 3s in the next 3 to 6 months, maybe in 2%. I think if we have enough sequential declines in personal consumption, the Fed will change its mind pretty dramatically. I think the Fed will look at the sequential numbers, many of which will be negative, and that will encourage them. Even if we don't get to that 2%, I think they'll change their mind. Company profits, they are going to be under tremendous pressure until some of these cost declines kick in and inventories are clear. Now, we do not think this will be anything like 2008 or 2009, which I know many people fear. We think it's much more of an inventory recession and a drag from the rest of the world. Europe being crushed by energy prices, China readjusting to common prosperity. So I think it'll be more of an inventory recession. And you know there's been a lot of denial about that we are in recession. We think we are, and that we'll be coming out next year. Whereas many forecasters are saying we'll be going in next year. So I actually think the market will be looking up as we're exiting this year. There's been some labor hoarding in here. The employment numbers have looked strong in the news. But if you peel the onion a bit, the underbelly of employment is not strong, with household employment essentially flat over the last 4 to 5 months, which includes a lot of small businesses. That's where we see a lot of the pain right now. I do think the inventory recession will be somewhat sharp, and will take the unemployment rate up, but I'd be surprised to see us get all the way to 6%. Our strategy has been hurt very much, as have most growth strategies, by the fears associated with inflation and higher interest rates. We see the growth coming out of these 5 platforms. These are 5 innovation stocks. These are exponential growth trajectories, and we've faced a lot of COVID-related comparison issues in stocks like Roku, Teladoc, or Zoom. So there's been a lot of confusion on very short-term indicators in the market, but the explosive growth is there. It has happened, and we think it's going to continue. We see that in the global public equity markets. Truly disruptive innovation, which is all we focus on, is priced at roughly $8 trillion in value in the markets today. That number, we believe, is going to more than $200 trillion during the next 10 years. So it's going from less than 10% of the global public equity market to what we believe will be 60%. And the reason we believe that it will move to that level is because these platforms are going to disrupt the traditional world order in a way like we have never seen before, and we will be at that moment to take advantage and collect all the value in our bets and give it to our investors. These 5 stocks involve 14 different technologies. So what we think, if we're right about what's going on in the economy right now, and inflation is going to come down fairly dramatically, that will be a big positive for growth stocks. What we do during periods like this is we concentrate our holdings towards our highest conviction names. We have taken our flagship strategy from 55 names down to 33 names. We did the same thing during COVID, but that was just a 1 month worth of pain. And from the lows in COVID, we moved up in the span of less than a year more than 360%. Now, we've corrected tremendously, and now we have many what I would consider deep value stocks. If our stakeholders give us a 5-year investment time horizon, the history of our portfolio will repeat again like in 2020. Don't forget to hit the like button and to subscribe and activate all the notifications of this channel. See you in the next video. Greetings and good investments.